Hey everyone, welcome to the subject income taxation. But before delving into or before getting into the details about what income taxation is all about, we will be talking first the overview of taxation. And this is the chapter 1, Introduction to Taxation. And by the way, we're using the book Income Taxation Laws, Principles and Applications by Mr. Rex B. Bangawan, CPA MBA. Let us now move on to the double taxation. So, double taxation happens when the same taxpayer is taxed twice by the same tax jurisdiction for the same object. Double taxation occurs when the following elements are present. Number one, primary element, and that is the same object. Number two, secondary elements, which includes same type of tax, same purpose of tax, same taxing jurisdiction, and same tax period. There are two types of double taxation, and these are the direct double taxation and indirect double taxation. The direct double taxation happens when all the elements, the primary and secondary elements, are present for both impositions. So, for example, an income tax of 10% on monthly sales and a 2% income tax on the annual sales. Annual sales refers to the total monthly sales. The second type of double taxation is the indirect taxation or indirect double taxation. So this happens when at least one of the secondary elements of double taxation is not common for both impositions. So for example, the national government collects income tax from a taxpayer in his income, while the local government collects a community tax upon the same income. Our law does not expressly prohibit double taxation, and as a matter of fact, indirect double taxation is common in practice. However, the direct double taxation is discouraged because it is oppressive and burdensome to taxpayers. So, the double taxation can be minimized by any or a combination of the following. 1. Provision of tax exemption. 2. Allowing foreign tax credit. 3. Allowing reciprocal tax treatment. And 4. Entering into treaties or bilateral agreements. We will be discussing this four ways of minimizing the double taxation in a different chapters. But for now, we will move on to the escapes from taxation. The escapes from taxation are the means available to the taxpayer to limit or even avoid the impact of taxation. So there are two categories of escapes from taxation. First is those that result to a loss of government revenue, and the second one is those that do not result to loss of government revenue. So we'll discuss first the first category, those that result to loss of government revenue. And this includes tax evasion or tax dodging and tax avoidance. And there's a third one, by the way, tax exemption. The tax evasion or tax dodging refers to any act or trick that tends to illegally reduce or avoid the payment of tax. So this one is punishable by imprisonment. So here are some examples of tax evasion or tax dodging. So we have here gross understatement of income. So like for example, your actual income is 500,000, but what you declare in your ITR is only 400,000. Another way is non-declaration of income. And then we also have overstatement of expenses or tax credit. So let's say for example, your actual expenses of your business is 150,000, but what you declare in your ITR is 300,000. Okay, so that is a form of tax evasion. The tax avoidance or tax minimization refers to any act or trick that reduces or totally escapes tax by any legally permissible means. So examples of this include selection and execution of transactions that would expose taxpayer to a lower taxes, and it could also be by maximizing tax options, tax carryovers or tax credits, and also by careful tax planning. So this is permissible by law. The tax exemption or tax holiday, on the other hand, refers to the immunity or privilege or freedom from being subject to a tax which others are subject to. So, tax exemptions, by the way, is granted by the Constitution, by law, or by the contract. We will now be moving on to the second category of the escapes from taxation, and that is those that do not result to loss of government revenue. So we have first one is shifting. So this is a process of transferring tax burden to other taxpayers. So there are three forms of shifting. We have forward shifting, backward shifting, and onward shifting. So we have here forward shifting first. So this is a kind of shifting of tax which follow the normal flow of distribution. So the normal flow of distribution is from the manufacturer to wholesalers, and then to retailers, and then to consumers. So forward shifting is common with the essential commodities like food and fuel. Another form of shifting is backward shifting. So this is a reverse of the forward shifting. So this is common to non-essential commodities where buyers have considerable market power and commodities with numerous substitute products. The third one is onward shifting. So this refers to any tax shifting in the distribution channel that exhibits forward shifting or backward shifting. And then number two, we have capitalization. So this pertains to the adjustment of the value of an asset caused by change in tax rates. And number three, transformation. So this pertains to the elimination of waste or losses by the taxpayer to form savings to compensate for the tax imposition or increase in taxes. Okay, so let's now move on to tax amnesty. So tax amnesty is a general pardon granted by the government to erring taxpayers to give them a chance to reform and enable them to have a fresh start to be part of the society with a clean state. So this is actually an absolute forgiveness or waiver by the government on its right to collect and its retrospective application. And then we also have tax condonation. So tax condonation is also a forgiveness of the tax obligation of a certain taxpayer under certain justifiable grounds. This is also referred to as tax remission. Let us now differentiate tax amnesty from tax condonation. So the tax amnesty operates retrospectively, meaning to say it is effective from a particular date in the past. That is why tax amnesty forgives the past violations of the taxpayer. While the condonation, this applies prospectively, meaning to say it will be effective from a particular date in the future. Again, condonation applies prospectively to any unpaid balance of the tax. So therefore, any portion of the tax that is already paid by the taxpayer will no longer be refunded. And that's it. So we're done with the chapter 1 of income taxation. I hope you guys learned something and thank you for watching.